Hey, you guys. So it's me, it's Garlinda Price, real estate broker and life and health insurance broker with Fusion Insurance Group. So excited to come to you today. Happy New Year. I wanted to get on here today just to talk about 10 life insurance myths, and we're going to bust them out the water, right? And so I've been wanting to do this video for a while. I've gotten some notes. I have them on my computer so I can stay on task because I tend to ramble. But for those of you that are new to my channel, I own a real estate firm and I also own an insurance brokerage. And I'm so excited because we're growing by leaps and bounds. We are hiring licensed life insurance brokers, which we're so excited about. So if you're licensed in life and health, we'd love to talk to you. And you have to be in the United States. I really appreciate that so many people have reached out to me that are overseas, but we can only hire here in the United States and it's outerlying territory. So like Puerto Rico, U.S. Virgin Islands, Hawaii, those areas. So I apologize for my European and African just followers that have reached out to me, and I'm sorry we can't bring you on board, but I wish you success there in your country. This is definitely an incredible opportunity, life and health insurance. And so these are 10 of the life insurance myths that we want to bust right now out the water for 2023 because we hear it all the time in the industry, and some of them are just not true. Well, all the ones I'm going to talk about, they're not true. So myth number one, I don't need coverage because I'm single and I don't have dependents. Every single person needs life insurance to cover the cost of personal debts, medical bills, funeral bills. If you're uninsured at the time of your death, you may leave a legacy of unpaid expenses to your family and for the executor or executrix of your estate to have to deal with. That means that when they go to file your estate down at the courthouse, they're going to have to open it up for creditor claims. And let's say that there's not enough money to cover those things. You don't know what happens in the event of your death, but you don't want to leave your loved ones having to address and take care of that. And when you're younger, insurance is so inexpensive. I mean, it is ridiculously inexpensive. So that myth, busted. Plus, this can be a good way for low-income singles to leave a legacy to a favorite charity or other cause. So let's say that you are a young person and you do have money or you make a significant income and you say, I have a favorite charity, whether that's the ASPCA, whether that's Second Harvest, which is the food bank here in our local area, a charity near and dear to my heart. And so let's say it's any charity that you love and you want to leave money to, you can get an insurance policy and make that charity the beneficiary. How cool is that? The second myth we want to bust, and I definitely hear this one a lot, my life insurance coverage only needs to be twice my annual salary. Well, the amount of life insurance needed depends on each person's specific situation. There are many factors to consider. In addition to medical and funeral bills, you may need to pay off debts such as your mortgage, right? So, and provide for your family for several years. A cash flow analysis is usually necessary to determine the true amount of insurance that must be purchased, and we can help you figure that out by doing a financial needs analysis, right? So as licensed life and health insurance brokers, we can talk about what your monthly expenses are. We can talk about what gap your income, if it were not there, will leave for your family. We can talk about critical illness coverage and what if you don't die, but God forbid you get in an accident and you can't work or you're incapacitated or you get a terminal illness and your income needs to be replaced. What if twice your annual salary isn't enough, right, to cover medical bills, funeral expenses, groceries, mortgage payments, all that stuff? So we need to do a financial needs analysis. It is paying less. I think that's a lot of times why people don't want to talk about insurance because they feel like it's talking about death. No, it's talking about living because we're not just talking about life insurance. What if you want to build and grow wealth? Let's talk about annuities. Let's talk about index universal life. Let's talk about whole life that you can borrow against while you're alive. Let's talk about critical illness coverage that will take care of you and cover all of your monthly expenses if you have enough, right, insurance to cover that gap while you're recuperating. We ain't just talking about when you die, right? You can benefit from it while you're alive. This is the number one myth I hear all the time. My term life insurance coverage at work is sufficient. No, it is not, right? Maybe or maybe not, right? For a single person of modest means, employer paid or provided term coverage may actually be enough. But if you have a spouse or other dependents, how do you know that they will have enough to cover your estate taxes, to cover any additional fees, to cover any additional expenses, all this stuff that happens in the event of a death or a loved one? But not only that, what if you lose your job? What if your group insurance policy is tied to that group, and if the company goes out of business, you decide to change jobs, you decide to become an entrepreneur and you no longer work there, and now you no longer have the benefit of that group policy or that group coverage, now you don't have insurance, right? So it is always super important to have a policy that you and your spouse, that you own for yourself, that you have for your children, that you all own. It's so important to have ownership of your own policies, because then guess what? You're in control of your financial life. You're in control of your financial future, and not that job or that company, should you choose to leave or stay. And you could just do something small. Start out small and go from there, right? And a lot of people would tell me, oh, my work coverage is so much cheaper. Yes, because it's a group policy. It is cheaper, right? Because there's more people on the policy, so therefore that makes it less expensive. But that doesn't mean you shouldn't have coverage just because it's cheaper. Cheap is not always better, right? The cost of my premiums will be deductible. This is not true in most cases, right? The cost of personal life insurance is never deductible unless the policyholder is self-employed and the coverage is used as asset protection for the business owners. Then the premiums are deductible on a Schedule C. So you don't want to make the assumption that your life insurance is a tax deduction, and so therefore you say, well, I don't need it because it's a tax deduction. It's not, unless you own a business. But of course you want to speak to a CPA. You want to talk to your tax professional. I must have life insurance at any cost. In many cases, this is probably true. However, people with sizable assets and no debt or dependents may be better off self-insuring. If you have medical and funeral costs covered, life insurance coverage may be optional. So if you're independently wealthy, I hear a lot of people say, well, I have the money in the bank. If they were to pass away, they have all the money saved up. But why wouldn't you want to leave the money that's saved up, that you put in the bank, to take care of your family, for them to enjoy and to go on vacation, or to invest it in real estate, or to invest it in other investments? Why wouldn't you want that money to do that? You could be paying this small amount of an insurance premium. That premium could then get a policy that pays for your funeral, pays off any medical expenses, pays off all their debt, and they get to enjoy and reap the benefit and the reward of the money that you left behind in the account. And the money in the account can't do everything. That's always a conversation that we have with clients, right? When they say, okay, well, what is that money earmarked for? And a lot of times people will say, okay, the money I have saved up is earmarked for my mortgage, to pay off the house. The money I have is earmarked to pay off my debts. The money I have is earmarked to pay medical expenses. The money I have is earmarked to leave to my kids. Well, depending on what it is, it might not be able to do all four things, right? So wouldn't you want to have a life insurance policy that would then take care of the majority of those things, or many of the larger items, and then they can enjoy the fruits of your labor, of all that money that you were blessed to save up? I should always buy term and invest the difference. How many times? That's probably the second largest or the third largest that I hear all the time. All the time. This is not necessarily true, because there are distinct differences between term life and permanent life insurance, and the cost of term life coverage can become prohibitively higher in the later years. Not only that, when you're older, and I would say over 40, looking to get term life insurance, and if you have any type of health challenges, term is super hard to get, right? So to say I'm going to buy term and invest the difference, and I hear this a lot too, is I have friends, I'm 54, so I have a lot of friends that are over 45, over 50, and they'll say, I want a multi-million-dollar policy. Well, you should have gotten that when you were younger, right? Because now that you're older, you can get it, but you're going to pay for it if it's term that you're looking for. So therefore, those who know for certain they must be covered at death should consider permanent coverage, whole life, universal life, those types of policies. The total premium outlay for a more expensive permanent policy may be less than the ongoing premiums that could last for years longer with a less expensive term policy. And think about this, and we talk about this in one of the videos, and I'll try to remember to post it here, where we talk about the difference between term life and whole life. So with that being the case, term is only for 10, 15, 20, 30 years, whereas whole life is until your age 120. It's never going to go away. Now, if you live past 120, honey, you deserve that money, right? Okay, and then there's also a risk of uninsurability to consider, which could be disastrous for those that may have estate tax issues, need life insurance to pay them. The risk can be avoided with permanent coverage, whole life or permanent life insurance, and which becomes paid up after a certain amount of premium and has been paid and remains in force until death. Variable universal life policies, this is another myth, are always superior to straight universal life policies over the long run. Many universal policies pay competitive interest rates. Variable universal policies contain several layers of fees relating to both the insurance and the security elements present in the policy. Therefore, if the variable sub-accounts within the policy do not perform well, the variable policyholder may see a lower cash value than someone with a straight universal life policy. Poor market performance could affect your cash in that variable universal policy. Ooh, this is a good one. I get this all the time. Only breadwinners need life insurance coverage. Ouch, and not true. So nonsense. The cost of replacing the services formerly provided by a deceased homemaker can be higher than you think. Did you know that a deceased homemaker is literally worth $100,000? So when someone says, I'm just a stay-at-home mom, or I'm just a homemaker, or I'm just, my husband works, but I don't work, and so all I do is stay at home, clean, cook, all those things. Do you know that that really has a value of almost $100,000, a six-figure income, a stay-at-home person? They do so much that is not factored in and accounted for, that in the event of their death, you think about all that you're going to have to do and insure and cover the loss. That includes homemaking, cleaning, daycare, everything, driving to and fro. And so think about it. It's not the breadwinner only that needs life insurance. If you're a stay-at-home mom, a stay-at-home parent, that person has an extreme value because they're the ones that run the household, right? I know so many people, husbands and wives, that don't even know where a checkbook is, never written a check, don't know what accounts are, don't know anything about their financial house because they're so used to the other spouse doing it. So if, regardless of whether you're a breadwinner, you need a life insurance policy. I should always purchase the return, another myth, I should always purchase the return of premium rider on any term policy. There are usually different levels of return of premium riders available for policies that offer this feature. Many financial planners will tell you this rider is not cost effective and should be avoided. Whether you include this rider would depend on your risk tolerance and other possible investment objectives. I agree that in multiple instances you should have a return of premium rider, especially when you're younger, because why not? It's not going to add that much more money to the cost of your monthly premium, and you're going to be able to get a return of your money back. And so even at best, if you choose the 50% return of premium rider, I'm all for that. You have 50%, you have 100%. Okay, here's a good one. I'm better off investing my money than buying life insurance of any kind. Hogwash. I've heard that so many times, and it's just not good financial sense. Just my personal opinion, and it's true, right? Even though it's my opinion, this person said hogwash too. I hear it multiple times. Like, who thinks like that, right? Hogwash. Until you reach the break-even point of asset accumulation, you need life insurance coverage of some sort, barring the exception discussed in myth number 5. Once you amass $1 million of liquid assets, you could consider whether to discontinue or at least reduce your $1 million policy or your life insurance, but you take a big risk when you depend solely on your investments in the early years of your life, especially if you have dependents. If you die without coverage for them, there may be no other means of provision after the depletion of your current assets. So in other words, once all that money is gone, what do they have? So it doesn't make sense to say, oh, I'm better off investing my money than buying life insurance of any kind. You should at least have a permanent insurance product, a whole life policy that you can borrow against. It's going to increase in value. Index universal life, annuities, right? Another myth. What do I ask myself when thinking about buying life insurance? Do you have the assets to cover your expenses after you're gone? If not, you need a life insurance policy to cover them. Who probably doesn't need life insurance? If you have medical and funeral cost coverage, life insurance coverage may be optional. Those with sizable assets, no debt or dependents may want to consider self-insuring. The bottom line is everyone is different. Everyone's needs are different. If you already have your funeral accounted for, you already have life insurance in place. Consider getting an annuity. Consider Index Universal Life if your health is good enough, right? Because, and we talked about that too, an IUL versus an annuity. We'll talk about that in a different video. But these are some of the myths that we busted today, right? Give me a call. I'm Garlinda Price, licensed life and health insurance broker. I'm licensed in multiple states. Contact me and we can find out if I'm licensed in your state, and if not, I can get licensed in your state and we can do business. It would be an honor to serve you and your family. My phone number is 910-494-7798. I'm also going to put it down in the discussion box, and also I'm going to put my Calendly link in there so you can schedule a time to meet with me, and that Calendly link is calendly.com/Garlinda P. So God bless you guys. I will see you again for our next insurance moment. Bye-bye.